All right. So now we're going to talk about the case study, which is adapted from November 2018. This was for 8 marks. So when I look at this case study, what is it we have here? So we have PB Limited, which purchased a plastic bottle manufacturing plant for INR 24 lakh on 1st of April 2015. Okay. The useful life of the plant is 8 years. All right. Okay. 8 years. On 30th of September 2017, always remember the dates are extremely important, right? The dates, cutoff, all of that is very important for you to get to the right answer, right? On 30th September 2017, PB Limited temporarily stops using the manufacturing plant because demand has declined, right? Because demand has, I stopped using the plant. However, the plant is maintained in a workable condition and it will be used in future as and when the demand picks up. The accountant of PB Limited decided to treat the plant as held for sale. Smart fellow, huh? Until the demand picks up, and accordingly measures the plant at lower of carrying amount and fair value less cost to sell. The accountant has also stopped charging depreciation for the rest of the period, considering the plant as held for sale. The fair value less cost to sell on 30th of September 2017 and 31st March 2018 INR 35 lakh and 12 lakh respectively. Okay. So on 30th of September, the fair value is the date on which in a way we realize that the demand has declined and we stop using the plant. The fair value is given on that date, that is 13.5 lakh. Originally also I purchased this for 24 lakh, right? With the useful life of the plant is 8 years, right? 8 years. That means what? Broadly 3 lakh rupees of depreciation per annum is what I'm supposed to charge. Okay. The fair value less cost to sell on 30th September and 31st March 18 is 13.5 lakh and 12 lakh, and I stopped charging depreciation. The accountant has made the following working. Carrying amount on initial classification as held for sale, it was how much? 24 lakhs. Then we provided depreciation into 2.5 years, which is perfectly fine. That is 7.5 lakhs, 3 lakh per annum, 3 into 6, and then 1.5, 7.5 lakhs. So my carrying value before it get classified as held for sale in the mind of the accountant, right? We'll have to assess whether that classification itself is appropriate or not, is 16.5 lakhs. And then fair value less cost to sell on 31st of March 2017 is 12 lakhs, right? And the fair value less cost to sell on 31st of March, actually this is 2018, okay? On 2018 is 12 lakhs, okay? Because that's the information which is given here, right? On 31st of March 2018 is 12 lakhs. The value which is lower of the two, which is 12 lakhs, right? So that's the assessment the accountant is making. So then we have the balance sheet extract as of 31st March 2018. Current assets, other current assets, asset classified as held for sale, which is 12 lakh. Now that comes the question, the real question. Analyze whether the above accounting treatment is in compliance with Ind AS. If not, advise the correct treatment showing necessary workings. All right. So the first question you need to remember now, which Ind AS we're talking here? Ind AS 105, right? Ind AS 105. Now, question is, first assessment which this guy has made, the smart accountant has made, is that he believes or believe that it is eligible to be classified as held for sale when they've only stopped using it, right? It is not been saying that put up for sale. So remember the criteria for classification as held for sale. is when there is a non-current asset, which is perfectly fine, in this case a plant and machinery, but when you intend to dispose it, not by way of continuing use or not by way of just kind of abandoning it. Okay, when you actually intend to monetize this by selling it, right, in an external transaction. So based on the fact pattern, that's not the case, right? And then what are the other criteria which we need to remember? That remember all the criteria we talked about, that it has to be available for sale in its immediate condition, right, in the present condition. And then management with the requisite authority has approved the plan to sell. You actively looking for the buyer. You are kind of trying to sell this at a reasonable price, right? And you expect to complete the sale within next 12 months, right? And you as management unlikely to change your decision. So when you meet all of these criteria, right, then only something gets classified as held for sale. And also remember the measurement guidance, right, which is the lower of the cost of the carrying amount, right? Lower fair value less cost to sell, or carrying amount, whichever is lower. But that's only relevant. The measurement guidance is only relevant when it meets the recognition criteria, right? Here, the recognition criteria itself has not met, right? So the initial accounting, what this guy is trying to do, the smart accountant is trying to do, to say that I'm going to classify this as held for sale, that itself is not appropriate. So let's just go through the solution here, okay? So what do we have here? As per Ind AS 105, non-current assets held for sale and discontinued operation. Remember what is discontinued operation we talked about, right? Discontinued operation is something where which is, let's say, a disposal group, which represent a separate major line of business or geographical area of operation, or a subsidiary acquired exclusively with a view to resale. So not every disposal group qualifies as discontinued operation, right? And discontinued operation is more of a presentation and disclosure matter. An entity, as per Ind AS 105, non-current assets held for sale and discontinued operation, an entity shall classify a non-current asset as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. Here it's not the case, right? For assets to be classified as sale, it must be available for immediate sale in its present condition, subject only to terms that are usual and customary for sale of such assets. And sale must be highly probable, right? And highly probable is defined as what? Something which is more likely than probable, which is more than 70-80% threshold, right? And probable is defined as more likely than not. Now, in such a situation, an asset cannot be classified as a non-current asset held for sale if the entity intend to sell it in a distant future, okay? Now, for the sale to be highly probable, again, all the criterias, the appropriate level of management, active program to locate a buyer and complete the plan must have been initiated in 12 months. You must be actively marketing it for a price that is reasonable. So essentially what we're trying to say, that none of these criteria are met here, right? In addition, the sale should be expected to qualify for recognition as a completed sale within 1 year from the date of classification. An action required to complete the plan should indicate that it is unlikely that significant changes to the plan will be made or that the plan will be withdrawn. So all the conditions, right? This is 1. Then this is active program is 2, then price is 3, and then 1 year, right, is 4, that 1 year criteria, right? And then this is 5. These are the 5 criterias, other than to say that it has to be highly probable, right? These are 2, which is immediate sale in its present condition, right? That's the 1 and the 2, and then further sub 5 conditions. All of this is in a way important for you to be in place. The only thing where the exception of available for sale in its present condition is when you acquire a non-current asset with a purpose to sell it, right? And that is likely to happen within 12 months. Then you have this 3-month window in a way to refurbish this, renovate it, and so on and so forth, right? And then you can still continue to classify this as held for sale, okay? But otherwise, it doesn't meet the test, okay? It doesn't meet the test. So move forward. What else we need to do? We need to also help compute all of the stuff, right? Ind AS 105 also states that entity shall not classify as a held for sale a non-current asset that is to be abandoned, is because its carrying amount will be recovered principally through continuing use. So again, if it is not forming part of Ind AS 105, then you can't stop charging the depreciation, right? When the asset become idle, and then you also, of course, have you need to do impairment assessment under Ind AS 36. All of that is what in a way become applicable here. The accountant of PB Limited has treated the plant as held for sale and measured it at fair value less cost to sell. Although the depreciation has not been charged thereon since the date of classification as held for sale, which is not correct and not in accordance with Ind AS 105 and Ind AS 16. So accordingly, what do we need to do here? Manufacturing plant neither be treated as an abandoned asset nor as held for sale, because its carrying amount will be principally recovered through continuous use. Shall not stop charging depreciation or treat the plant as held for sale, because its carrying amount will be recovered principally through continuing use to the end of their economic life. Okay, let's look at some more explanation here. Now, how do we work out this? The working of the same from the balance sheet perspective. So we have the purchase price of the plant, given information, then you provide depreciation is 9 lakh, carrying amount before impairment is 15 lakh at the year. Ind AS 36, right? And Ind AS 36, what is the impairment testing principles we have, which is that you compare the carrying amount with the recoverable amount. Okay, carrying amount with the recoverable amount, and recoverable amount is what? Higher of value in use or fair value, right? Basically in use or in exchange. Okay, now when you look at the value in use, since they have stopped using it, so value, you're not able to determine the value in use, so to say. So now you have the fair value which is given here, which is 12 lakhs. So essentially you end up recording a impairment charge of 3 lakh, as of 31st of March 2018. Okay, now from a balance sheet perspective, we will not classify this as held for sale. We will say property, plant and equipment, it is 12 lakh. Fair value less cost to sell the plant is 12 lakh. Value in use is nil, right? And recoverable amount is the higher of the above, which is 12 lakh, and impairment loss is 3 lakhs, right? That is how you got to answer this question. Okay, fairly comprehensive. So essentially, whenever you look at a question like this, right, on discontinued non-current asset held for sale or discontinued operation, just remember the principles, right? As to what is it we're talking about. We're first talking about a non-current asset. Okay, what is a non-current asset? Something which is not a current asset, right? And what is a current asset? We all talked about it. Something which forms part of your normal operating cycle, something which you want to buy or sell on a frequent basis, something which is cash or cash equivalent, something which you expect to realize in next 12 months. Everything else is a non-current asset. Now, what are the non-current assets? Like property, plant and equipment, your intangible assets, your investments, long-term investments, etc. They are your non-current assets, right? So then we have to figure out a disposal group, right? A non-current asset forming part of an asset group along with the associated liabilities. That is what I intend to sell. That is what I intend to realize by way of an external transaction. Okay, that's called a disposal group, right? And now, can I classify that disposal group as a held for sale? What are the criteria for that? The criteria for that is that it has to be available for sale in its immediate and present condition, and the sale is highly probable. And then we got to look at 5 more conditions, which is the management has the appropriate authority, has approved the plan, you started marketing this, you expect to complete it in 12 months, you're expecting a reasonable price, and you're unlikely to change your plans, right? Now, then you can actually classify this as held for sale. Now, once you classify this as held for sale, you got to look at the measurement principle. The measurement principles are lower of carrying amount and fair value less cost to sell. Carrying amount immediately before this being classified as held for sale. So you're going to look at that carrying amount and then compare it with the fair value less cost to sell. If there is any impairment at that point, there is any decline in unrealized loss, you're going to record that unrealized loss. And you allocate that unrealized loss first to the goodwill if this goodwill is forming part of that asset disposal group, and then the rest of the asset categories you're going to allocate it in the respective proportion. And again, remember, you don't need to allocate to let's say current assets, for example, or a deferred tax asset, for example, or an employee benefit obligations, for example, insurance obligations, for examples. We talked about some of those scope criterias, right, where there are where the measurement is actually guided by those respective standard financial assets, for example, right, which is covered under Ind AS 109. So otherwise, for those non-current assets, you're going to allocate the losses or in the respective proportion. And we discussed with a help of you example as to how we need to, in a way, do that. So now you got your carrying amount and your revised carrying amount, and then when you eventually sell it, then you record the gain or loss on the sale. If there's a subsequent decline in the fair value, you can again record the further loss, right? If there's an increase in fair value, you can record the increase in fair value to the extent of previously recorded losses, right? You're not supposed to record the gain. And also remember, the recognition of the reversal of losses is limited in a way to the extent of the losses. But if you've written off goodwill, that is not allowed to be recovered, because goodwill once impaired is not allowed to be recovered. All right, I hope that helps. Okay, now let's look at a new principle. When there's a change to a plan of sale, okay, then what do we need to do, right? This guy is smiling, good guy. I don't know why this guy is sad. Okay, such is life. Somebody's sad, somebody's happy. Okay, change to a plan of sale. Okay, what does that mean? That means that you're going back. Now you figure out that it's better not to sell it, right? It's better to keep it, better to use it, right? I think that's where you're changing your plan, right? So if an entity has classified an asset as held for sale, but the criteria are no longer met, the entity shall cease to classify the asset as held for sale, right? Now, how do you look at the measurement, right? So remember, we had stopped providing for depreciation. Now you got to recompute the depreciation and provide for it as if you never classified as held for sale, okay? Now, carrying amount adjusted for any depreciation, amortization on revaluation, okay? And you compare that with the recoverable amount on the date of such reclassification, okay? And record such losses, okay? Record such losses through the profit and loss account, if there is any, okay? Now, a non-current asset that ceased to be classified as held for sale is measured at the lower of the carrying amount had the asset not been classified as held for sale. What does it mean? It means that you now need to continue to provide for depreciation for all the period for which you have not provided the depreciation, right? So you got to compute that amount, okay? And we will help you understand with the help of an example, right? It's recoverable amount, which is higher of fair value less cost to sell and value in use, right, at the date of the subsequent decision not to sell. So on that date, in a way, you're again doing an impairment testing. Adjustment is recognized in profit or loss unless the asset was measured at a revalued amount, okay? If an entity removes an individual asset or liability from a disposal group classified as held for sale, all right? If an entity removes an individual asset or liability from a disposal group, which is classified as held for sale, the remaining asset and liability disposal group will continue to be measured as a group only if the group meets the criteria for classification as held for sale. So for example, if let's say the core of the non-current asset, which was forming part of the disposal group, if that itself is removed, then it is no longer as held for sale, right? You go back, right? Go back as if there's a change in plan. However, let's say you've taken off some receivables, you've taken off some liabilities, that's okay, right? That doesn't change the character, right? That doesn't change the disposal group significantly, okay? So The remaining non-current asset of the group that individually meet the criteria to be classified as held for sale shall be measured individually at the lower of the carrying amount and fair value less cost of sale at that date, and any non-current assets that do not meet the criteria shall cease to be classified as held for sale. Now, if that being the case, you go back and then you apply this, okay, which is to say that I have to provide for depreciation, and I also have to test it, for its recoverable amount, and then the lower of the two in a way becomes my revised carrying value on the date of such decision, on which I have decided not to sell it anymore. All right. We will try and do this with the help of an example. Okay, let's try and do this with the help of an example. All right, so Nature Limited purchased a building, Ocean Bay, for INR 6 crores on 1st of April 2017. Okay, on 1st of April 2017. The useful life of the building is 15 years. The useful life of the building is 15 years. On 31st of March 2019, okay, so I purchased this on 1st April, okay, and life is 15 years. Now on 31st of March 2019, which is what? Exactly 2017, 18, 18 and 19. This is after 2 years, okay. Nature Limited classified the building as held for sale. The estimated recoverable amount at that point in time is 4.7 crores. Now, the fair value less cost to sell on 31st of March 2019 was INR 4.6 crores. Okay, all right. On 31st of March 2020, Nature Limited, on 31st of March 2020, Nature Limited changes plan to sell as the building no longer meet the criteria as held for sale. The recoverable amount on 31st March 2020 is INR 5 crores. All right. So fair value less cost to sell was 4.6 crores. Then on March 2020, you change your plan. On the date when you change the plan, the recoverable amount is 5 crores. You are required to determine the value, the building Ocean Bay, as at the end of 31st March 2019 and 31st March 2020. Okay. Since we don't have the lot of information, we assume that the criteria for held for sale is met. Okay, because that's a given information. Now I have, it is like for 6 crores for 15 years, right? So 6 crores in a way, many zeros. Okay, 6 crores. Okay, divide by 15. How much depreciation per annum is 40 lakhs, right? 40 lakhs depreciation is what I need to charge here. Okay, what I need to charge, 40 lakh rupees depreciation per annum. And I said we used it for 2 years before we decided that time to let go of this property, right? So 6 crores minus 40 lakhs into 2 is 80 lakhs. I'm left with 5 crore 20 lakhs, but my recoverable amount is 4 crore 70 lakhs. That means what? Looks like there is an impairment there, right? So let's just go through the solution. Okay. So when I look at the value of the building before classification of sale as on 31st March 2019, that's what I'm trying to determine here, right? Purchase price was 6 crores. I'm going to charge depreciation 80 lakhs for 2 years. Now impairment, which I'm going to record, which is because my recoverable amount on 31st March 2019, the information given is 4,70,000. That means there's an impairment loss, another impairment loss of 50 lakhs. So my carrying amount is 4.7 lakhs. That's immediately before classification of this as held for sale. Okay. Now I'm going to look at on initial classification, the value will be lower of your carrying amount or fair value less cost to sell. Now, what is my fair value less cost to sell? Carrying amount is 4.7 crore. Fair value less cost to sell is 4.6 crore. So I'm going to record another loss of 10 lakh rupees. Okay. So on 31st of March 2019, my carrying value will be 4.6 crores. So in a sense, I'm going to record lots of losses, right? For March 19, which is first I'm going to record a 40 lakh of depreciation for that year. Then I'm going to record 50 lakh of impairment, and then I'm going to record another 10 lakh of impairment. So total P&L hit actually is almost a 1 crore, right? 100 lakhs, 1 crore in 31st March 2019. In a way, that gives me my revised carrying value of my held building, which is classified as held for sale at 4.6 crores, right? Depreciation, I'm recording impairment loss of 60 lakhs as charged to profit and loss account, which is what I was trying to do here, right? A crore, almost a crore is gone. Okay. Now we got to now compute March 20, and there is a change of plan. Okay, so I come to March 20. On 31st of March 2020, property held for sale is reclassified as criteria doesn't met. The value will be lower of carrying amount immediately before classification, which is 4.7 crores, less depreciation based on remaining 13 years of life, which is 36 lakhs 15,400. And so assuming if I would have provided for depreciation, that would have been 4 crores 33 lakh. Recoverable amount is 5 crores. Recoverable amount is 5 crores. Okay. So the building will be carried at 4 crores 33 lakh 84,600. Adjustment to the carrying amount of INR 26 lakh 15,400 is charged to the profit or loss account by Nature Limited. Okay, so I'm going to charge this to the profit or loss account. Okay, I'm going to charge this to the profit or loss account. I hope this is clear to you, right? So in a way, what you need to do, imagine as if the property is continuing to be in use. Now the one thing which has changed here is that your base value, book value, in a way I would say, of that asset which is classified as held for sale, that becomes that book value, okay, immediately before the classification. So the remaining 13 years depreciation you are carrying on with reference to this, not with reference to original 6 crores. If you would have computed depreciation with reference to original 6 crores, then your depreciation charge would have been 40 lakhs, right? But that's not the case here. Here, your book value, the gross value, the moment you take it out from your fixed asset base, the moment you classify something as held for sale, the gross value also comes out of your fixed asset register, right? And the accumulated depreciation comes out, right? And then it is held for sale at that value, which is 4.7 crore. And then you further assess it for lower of the fair value less cost to sell or the carrying amount, that was 4.6 crore, but you compare that with the 4.7 crores. And then say on this 4.7 crore, if I would have provided for depreciation for remaining 13 years, that would have been 36 lakhs, right? And then the value comes at 4.33 crores. Whereas my current fair value is, my current carrying value is 4.6 crores. Whereas the recoverable amount is now 5 crores, which is higher. So I'm going to record this differential 4.6 crores versus 4.3, and that additional P&L charge as depreciation is what I am going to record in my financial statement, and then I'm going to move it back, right, to my fixed asset register. Okay, I hope that in a way makes sense for you. Now we're going to talk about some of the presentation and disclosure, right? And as I said, that we're also going to look at one of the real case study, right, on discontinued operation or held for sale. Okay. Now, when you look at the presentation of non-current asset, which is held for sale, what are the things we need to worry about? Okay, on the face of the balance sheet, non-current assets and assets of the disposal group classified as held for sale on the face of the balance sheet, right? Shown separately from other assets. It comes into the main balance sheet. Liabilities of disposal group classified as held for sale shown separately from other liabilities. It's not that they're clubbed together. They're not clubbed together. Liabilities are presented separately. Assets are in a way presented separately. Both together form part of your disposal group. Comparable amount for prior periods are not reclassified or represented. Important point to remember, right? Comparable amounts are not represented or reclassified. Now, major classes only for the held for sale. Comparable amounts you do for discontinued operations. Okay. Now, major classes of assets and liabilities disclosed either in the balance sheet or in notes, except when the disposal group is a newly acquired subsidiary. Now, gains and losses on remeasurement are included in profit and loss from continuing operations unless the group meets the definition of a discontinued operation, and we're going to talk about some of that as well. Okay, now disclosure of non-current assets held for sale. So continuing with more disclosure. So disclose and disclose. An entity should disclose the following information in the notes of the financial statement: description of the non-current asset, description of the facts and circumstances, gain or loss recognized, if not presented in the statement of comprehensive income, the caption in the statement of comprehensive income that include that gain or loss, the reportable segment, right, in which the non-current asset of the disposal group is presented in accordance with Ind AS 108. If there's a change of plan to sell, a description of facts and circumstances leading to the decision and its effect on results. If you're intending to change your plan, that's what you need to do. Okay. So now we're going to move and talk. So whole host of disclosures, yeah. I mean, that is Ind AS is a lot about disclosures, right? Now we're going to quickly talk to you about the disclosures of discontinued operation. Thankfully, there are no measurement guidance, okay, in relation to discontinued operation. Measurement guidance are more in relation to the assets or asset group classified as held for sale. Okay, discontinued operation is more of a presentation and disclosure matter. Okay, now first you got to make sure that it qualifies as a discontinued operation. Now, what is a discontinued operation? Something which represents a component of an enterprise, right? Component of a business which actually represent, and it's an and condition, and what, and it represents a separate major line of business or geographical area of operation, or being sold as a part of single coordinated plan where you going to eventually get rid of a major line of business or a geographical area of operations, or it is a subsidiary acquired exclusively with a view to resell, right? Then only it qualifies as a discontinued operation and hence required to be presented separately. Okay. Now, when you look at a presentation of a discontinued operation, you need to present them. That enables you. Why do you need to present it? Because as a user group, then I'll get to know my continuing operations and discontinuing operation. You should disclose a single amount in the statement of profit and loss. Single amount related to the sales goes away, the cost goes away, everything goes away. In a way, single amount post-tax profit or loss of discontinued operation. Post-tax profit or loss of discontinued operation and post-tax gain or loss recognized on the measurement to fair value less cost to sell or on the disposal of the asset or disposal group constituting the discontinuing operation. So essentially, when you're presenting your P&L, anything which is related to the sales, the cost, the SG&A, the depreciation, all of that in a way goes away. It just gets presented as one single line item as post-tax profit or loss of discontinued operation, assuming, let's say, you're continuing that operation. If you're still running it, you've not been able to get rid of it. Now, in the period in which you get rid of it also, then you also present the gain or loss on in relation to sell, if you eventually been able to dispose this, that also in a way gets reported. Okay. What more? So analyzed into, did you do a separate disclosure, right? Revenue, expenses. Let's look at it. So in the notes, right, you also going to disclose the net amount into what was the revenue, expenses, the pre-tax profit or loss of discontinued operation. All of that are presented like a short P&L, right? It's presented as part of the notes to accounts. uh, the related income tax expense as required by Ind AS 12, the gain or loss in relation to the measurement to fair value less cost to sell or disposal of the asset or disposal group constituting the discontinued operation, the net cash flow attributable to operating, investing, and financing are also presented on a net basis, right? So when the amounts related to discontinued operations are presented separately, the comparative figure for prior periods are also represented. Remember, for disposal group, for held for sale, you don't do the comparative restatement. But if it is a discontinuing operation, then you need to also restate your comparative information. Amount of income from continuing operations and from discontinued operation attributable to the owners of the parent. All right. These disclosures may be presented either in the notes or in the statement of profit and loss account. Let's look at the extract from the annual report. We will look at this very quickly of Ultratech. Okay, that's the consolidated balance sheet. It's a publicly available information as at March 31st, 2019, rupees in crores. Okay. And you have March 31st, 2019 and March 31st, 2018. I have assets, non-current assets. I have total non-current assets. I have then current assets. What do I have here? I have here this. This is what we were looking at. Asset and disposal group held for sale. Held for sale. Okay. That is what is presented here, right? That is what is presented, which is a sizable amount, 1093 crores, right? That is what the asset or disposable group, which is held for sale. Okay. Similarly, you have the total liabilities, and then liabilities are also presented in relation to the disposal group, which is held for sale. Okay, disposal group which is held for sale, right? So equity share capital, we have share application money, we have non-current liabilities, all the other stuff, but what we are focused here is the liabilities. So assets, disposal group presented as one, taken out from respective asset categories, presented as one asset group. Similarly, liabilities as presented as one, in a way, liability group. And then when you look at the P&L, right, P&L says what is my continuing operations, right? What is my continuing operations? What was my total expenses? What is my profit from continuing operations? And then profit from continuing operations, all of that, right? And then at the bottom is what you see is your discontinued operation, right? Profit before tax as one single line item is what is this as presented. One single line item, profit before tax from discontinued operations, tax expense of discontinued operations, impairment of disposal group classified as discontinued as held for sale, all of that in a way are presented separately from your, so you have one profit from the continuing operations and then your discontinuing operations, right? And then profit after tax from discontinuing operations. So in a way, it's remember it's a separate presentation. Okay, it's a separate presentation which you need to take it out. Okay. And then similarly, you have a notes to accounts. Okay, notes to accounts. What do the notes to accounts suggest? Is that you can look at this, which is to say that consequent to the which is basically the both note 59, right? Notes 59, A and B. The group has identified certain assets like aggregate mines, grinders, vibrating mill, naphtha-based power plant, which are available for sale in its present condition. The group is committed to plan the sale of these assets. Active program to locate a buyer and complete the plan have been initiated. Expect to dispose the asset within 12 months, right? All the criteria have been met, right? It is immediately say available. You are actively looking at it. You want to complete the plan, and you expect to finish it in 12 months, right? Now, consequent to and of course, there's a decision's been taken, right? Now, consequent to the acquisition of UNCL, the group has identified the disposal group, which is a foreign subsidiary. Subsidiary is acquired with a view of resell, looks like the criteria that meet the criteria to be classified as held for sale on acquisition, as these are not considered core to the groups, blah blah. Then the group expects to sell the disposal group within 12 months from its classification. All of that is what is being provided here, is in a way relevant or practical example as applied by a large company of the standard Ind AS 105. I hope all of this been clear to you, right? In terms of the principles we've been talking here, right? It's an interesting standard. It's an interesting standard. Okay. Quickly looking at it, the differences between Ind AS 105 and AS 24. One big difference between AS 24 and Ind AS 105 is that AS 24 actually do not provide any measurement guidance. AS 24 is largely a recognition or a presentation and disclosure standard, whereas Ind AS 105 is not only a recognition standard but also a measurement standard, right? That's the fundamental difference between Ind AS 105 and AS 24. So it specifies the accounting for non-current assets held for sale and the presentation and disclosure of discontinued operation. AS24 established the principle of reporting information about discontinuing operations, right? That's where AS24 is focused on, about discontinuing operation. It doesn't look at asset categories which are held for sale, right? They are largely covered under Ind AS 10. The definition is a discontinued operation is a component of an entity that represents a separate major line of business or a geographical area of operations, right? Now, in AS24, a discontinuing operation is a component which has a discrete financial information that represent the major line of business or geographical area operation that can be distinguished operationally and for financial reporting purpose, right? So here the reference to subsidiary in a way is not there, whereas we have the reference to subsidiary in AS 105. As I said, AS24 doesn't provide the measurement guidance. Ind AS 105 provide you for the measurement guidance, lower the carrying amount and fair value. It apply the principles in other relevant Ind AS, right? So you're going to look at AS10, you want to look at the impairment standard, AS28 and other standards, but it doesn't provide, the AS24 itself doesn't provide the in a way the measurement guidance. When you look at the abandonment of the asset, it specifically mentions that the abandonment of an asset should not be considered as something as held for sale. Whereas in AS24, abandonment is classified as a discontinued operation. However, changing the scope of an operation, the manner in which it is conducted, is not abandonment and hence not a discontinued. So, abandonment possibly can qualify as a discontinued operation under AS24, but not under Ind AS 105. Right, in a way, it doesn't qualify, right, as held for sale. Okay, and we need to see that whether it represent component which represent separate major line of business or geographical area. So extremely unlikely, as I said, to my mind, that you will simply abandon something of so large, so meaningful, and then it get classified as discontinued operation without you even trying to monetize it, right? Why will you do that? So guidance regarding measurement of change to a plan of change. So of course, because it provides a measurement, it also provide perspective that if you were to change your plan, then how this needs to be remeasured, as if you were continuing to provide the depreciation, compare with the recoverable amount, on the date of such reclassification, and then record any additional losses which you need to record on that date. And then AS24 doesn't provide, since it's anyway it doesn't deal with the measurement guidance. And the time period, it talks about like 12 months, though that's a rebuttable presumption. Remember, that's a rebuttable presumption. Whereas AS24 does not specify any time period in this regard, as it relates to continuing operations. All right. So a few more questions, right? And what I'm going to do is, my colleague will take you through all of these questions, right? Which are out there. So happy learning, happy learning. Do write to us, do provide us your feedback. Okay. Thank you very much.